What most people leave out of this theory that you and I are discussing, the 3% versus the 10% mutual fund, the 7% spread appears to be there. What we leave out of that theory is risk.
Should you pay off your debt or prioritize investing and try to outperform your loan rate? Now, this is a question that is asked ad nauseum, and on one side of the debate, you have the Dave Ramseys of the world, constantly telling you to pay down your debt. On the other side, you have investors and advisors alike that show that historically you've been able to outperform loan rates through investing. So who's right? Well, I find there's a very important variable left out of this equation, one that Dave Ramsey alludes to in the opening clip. In today's video, we're going to talk about the risk side of this debate. Let's get into it. Now, proponents of the take on debt and invest approach show some fairly compelling napkin math. Even though interest rates have risen and thus loan rates have risen, there is still a potential spread that can be earned. For instance, if we look historically at stocks averaging 10% per year, and we look at even a loan rate today at 7.5%, there is still a 2.5% per year benefit that you can earn. Now, if we take a $250,000 loan, 2.5% over a 30-year loan will end up with you earning about $274,000 in addition to paying off that loan. But the problem here is that this napkin math leaves out some very important variables, as napkin math typically does. Now, when we think about paying off debt has some important parallels to retirement. And the reason for this is because when we're investing in order to pay off debt, we can't just invest that sum of money for 30 years and then expect to pay off that debt. That debt has to be paid off on an ongoing basis. Similarly, in retirement, when we're taking income from our portfolio, we're taking it on a monthly basis. And as we've discussed quite a bit on this channel, when we're taking money out on an ongoing basis, we enter into this idea of sequence of return risk. So when the market is down and we're withdrawing from our portfolio, we are furthering that drawdown, thus making it more difficult to recover and thus earn the benefits during that recovery. And so let me try to show this with an example. I have two charts on the screen right now. On the left-hand side of the screen, I have a stock portfolio simulation. Now, our expected return here is 10%, but our expected volatility is 17%. Now, as you see off of this simulation, this portfolio grows from $100,000 up to almost $1.4 million. And so then based on the napkin math, we would assume that if we're paying off a loan at 7.5%, but we're earning more than 9% on our portfolio, the math should work out and we should thus earn a spread. But as you see with the graph on the right-hand side of the screen, this napkin math really starts to break apart. And again, the reason for this is sequence of returns. It's not as if we're investing in a 10% CD, but rather we're investing in a volatile investment. And this volatility drags down returns when we're taking withdrawals. I want to take this idea of comparing debt and retirement one step further. Now, when we talk about retirement and what we can safely take from our portfolio, we talk about safe withdrawal rates. And generally in retirement, the safe withdrawal rate is thought of as 4%. Well, interestingly enough, if we take loan rates and we translate them into withdrawal rates, we see some surprising math here. So for instance, if you're paying a 3.5% loan rate, you're paying an equivalent withdrawal rate of 4.49%. On the other extreme, if you're paying an 8.5% loan rate, that's an equivalent withdrawal rate of almost 7.7%. Now, it is worth noting we aren't completely comparing apples to apples here. When we talk about a safe withdrawal rate for your retirement, we're talking about the risk of ruin. For instance, if you take too high of a withdrawal rate and you run out of money, that's a much bigger issue than if you have, let's say, a $3 million portfolio. You're taking out a $250,000 loan. Now, if you end up investing and losing on investing compared to that loan rate, you still have savings on the outside that you can overcome and pay a little bit extra on that loan. You lost, but you have those savings on the outside. We're not talking about the risk of ruin. But nonetheless, this does show an interesting example and reframe the loan rate we are paying relative to that withdrawal rate. And so when we look at current loan rates around 7.5%, and we see that that translates to a 7% withdrawal rate, again, this reframing might offer some interesting context for whether we're really comfortable taking out that debt and investing. Now, all this being said, we don't need to just keep asking this question theoretically. We can take this idea, take these parameters, and start to simulate portfolios and decide which approach really makes sense. Now, first off, what we're going to look at is using historical based parameters and looking at an all stock portfolio. And so let's use current loan rates here at 7.5%. We'll use an expected return of 10% and expected volatility here of 17%. Now, the first thing we'll see based on this simulation is that there's a little bit better than a coin flip chance that taking on debt and investing under these variables makes sense. We see only a 55% probability of success under these given metrics. Now, I show on the graph different percentiles broken out to try to show the extremes on both sides. And as we can see, there's a lot to be risked, but there's also a lot to be gained here. Now, if we focus on the median trial, that 50th percentile trial, we see that there is a positive outcome. Now, for some of you that are much more risk tolerant, maybe the reward does outweigh the risks here. But understand that this is a far throw away from the initial napkin math that was shown. But for most of you, based on your retirement plan, taking on that added debt and trying to earn that added reward won't be worth it, especially at these higher loan rates. But what happens if we start to adjust that given loan rate and we adjust it down to 4.5%? Some of those loan rates we saw a couple months ago. Well, now the math changes quite heavily. And so understand a very key variable here is the loan rate that you pay. And so now when we look at the same simulation under the same risk return profile, but the only thing we change here is taking that loan rate from 7.5% down to 4.5%. Now we see the case for taking on debt and investing the rest becomes much stronger here. Now we see that there are over 82% of trials that are successful. Now from the last set of simulations that we showed, the 50th percentile showed about a $60,000 economic benefit. Now under this trial, we see there's about a $390,000 economic benefit. And so we can see here, at least from the quantitative side, the most important variable, all things being equal, is what loan rate are we paying? The lower the loan rate, the better chance we have to outperform. Now this shouldn't be surprising to too many people, but here's what might be surprising. If we change up the risk return profile of our investment and we add a little bit more safety and thus lower the investment returns, you would expect that we should see worse results here. It might surprise you, however, that we actually see better results. We're going to still look at a 30-year loan with a 4.5% interest rate, but now we're going to look at our investments earning 8% as an expected return with only 10% expected volatility. And interestingly enough, before we only had about an 82% probability of success. Now we have an 89% probability of success. Now, why is that? Well, the reason the napkin math looks to work out is because it doesn't add in any volatility. For instance, if we could earn a 10% CD and we're paying a 7.5% loan rate, well then that should work out over time. We're earning 10% each and every year and we're paying out 7.5%. The problem with earning 10% is there's no 10% CD. We have to earn a volatile 10%. And so when we take our investment portfolio and we're able to add safety and thus lower the volatility, but still maintain a high enough return, the probability of success does rise. Now looking at this graph, we see that in the 10th percentile, we see the lowest risk that we've had out of any of these other trials. But let's bring this back to whether it makes sense to take out a loan today, looking at different portfolios with different returns and different expected volatility. Now on the screen, I have 25 different portfolios, each with a different intersection of expected return as well as expected volatility. Now what we'll see from this analysis is taking on debt right now and trying to overcome that debt within our investment portfolio is a very difficult task. For instance, the only time that we see really positive results are underneath some fairly unrealistic risk return metrics. For instance, sure, we do see a 100% probability of success when it comes to earning a 12% return with 0% volatility, but I don't know of any CD that can mimic that risk return profile. And so we know the higher return that we earn, the more volatility we're gonna have to take on. And when we look at more of a balanced portfolio of thus lowering the return, but also lowering the volatility, unfortunately, there's not enough added return to overcome that 7.5% loan rate. And so at least with this analysis, under the current debt climate that we face, it'd be very difficult to go against Dave Ramsey on this front and try to earn that added return. But know that the math heavily adjusts when we adjust the loan rate down to, well, the loan rates that we saw just a couple of months ago. 3.5% is what we're showing on the screen right now. Know that this idea of taking on debt and investing the rest, quantitatively at least, will be in your favor in a big way. As you can see on the screen, the majority of trials here now are positive, almost regardless of what risk return profile you look at. Now, although we focus mostly on the quantitative side of this question in this video today, understand there are two sides of this question. There is the quantitative side, what makes economical sense, but there's also the softer peace of mind side. And so if you're somebody who, if you took on debt, it would cause you to lose sleep at night because you hate the idea of debt, as Dave Ramsey does, it may make sense to forgo the quantitative side and pay down that debt as fast as possible, regardless of the math. But also understand that the peace of mind and quantitative side are interconnected. For instance, I have a mortgage at around a 3.5% loan rate. And after seeing this data, It would cause me to lose more peace of mind to not make the quantitative focused decision because the numbers are so heavily in the debt and invest favor, and there's a lot less to risk. Now, this may be different for you, and that's all right. Again, when we think about all of these type of decisions, we need to be thinking about both sides. I hope you enjoyed this video. I hope you enjoyed the quantitative look at this side of debt as well as retirement. If you're someone who regularly uses napkin math to plan out your finances or retirement, you're going to like this video right here, where we talk about yet another reason why some of this napkin math leaves a lot to be desired. We talk about 3 problems with the 4% rule and how to fix them for your retirement. Thanks for watching, and always remember, you don't need more money, you need a better plan.